Good morning, everybody, and welcome to the November edition of our Economic and Investment Update. Thank you for joining us this morning. Apologies for keeping you waiting a couple of minutes. A slight technical issue our end. For those of you who have not been to our webinar before, my name is David Baker. I'm Chief Investment Officer here at Mazars, and I'm joined as ever by our Chief Economist, George Lagarias. So we'll talk a little bit about what's happening in markets. A lot of volatility there, as you, I'm sure, will have noticed this year. And then George will talk us through the economic backdrop of what's happening in the world and what's driving a lot of those market returns. So hopefully we'll talk for 30-35 minutes, and then we will take some questions. We have had, and thank you for this, a lot of questions in advance. So if you do want to ask a question, please do that in the Q&A rather than in the chat function. But as I said, we've had a lot of questions in advance, so I'm probably going to go with the pre-submitted ones. But if there is a good question comes through in the Q&A, then we'll try and fit that in as well. So where to start? What's been happening in markets in the last couple of months? If we can flick on. Thank you, Jordan. So in isolation, just looking at this in the last 2 months, everything looks pretty rosy. Equities are up, bonds are up, gold is up in dollar terms at least, and you'd be forgiven for thinking that all is well in the world. But of course, that has to be taken in context of what's happened throughout this calendar year, when both equities and bonds have slid quite considerably. But nonetheless, a good rebound from markets over the last couple of months since we last spoke to you. US equities up over 10%, European equities off the back of a very good earnings season, despite their issues around energy costs, up 14% in euro terms. So, another example of equity markets trying to bounce back. We've seen this a few times through this year, where markets have tried to get ahead of monetary policy easing, going from a tightening cycle into an easing cycle, trying to predict the end of that and saying, well, when that comes, everything will be a lot easier in the economy. And that is justification for stock markets going up. So as I said, we've seen this a couple of times already. So it may be this is another short-lived bear market rally. What else to say? We took in our portfolios at the end of September, we took our overweight US dollar position off because it looked quite obvious to us that that was a little bit overdone. People in times of stress going to the dollar. So we reduced our gold exposure and reduced our unhedged equity positions, and you can see the pound appreciating quite considerably, 13% in the space of a couple of months, appreciating against the dollar. Now, some of that obviously is because of what's happening in the UK. We've got a new Prime Minister, a new Chancellor, and an absolute about turn in terms of fiscal policy in the UK. No longer going for growth and spending lots of money, but actually cutting back on fiscal expenditure and indeed raising taxes. So that's given the bond markets a little bit of comfort that the UK is going to be more fiscally responsible, and that's what's led primarily to the pound rising against the dollar to that extent. Probably worth saying, a lot of those measures that Jeremy Hunt brought in are not necessarily impacting this year or next, but pushed out to 3, 4, 5 years from now. And that does raise a question in our minds as to how far you should trust that those changes are actually going to happen. A lot can happen in a few weeks in politics, as we've seen very recently. So what's going to happen over the next few years, particularly when you get into start thinking about the next general election? Possibly some of those fiscal measures we will read about but never actually see in reality. So the pound strengthened, but also fair to say the dollar has weakened against pretty much all currencies. That'll be good for them in the US from an exports perspective. But you can see there that where you've got nominal returns, good returns in gold and in US treasuries, by the time you've brought those back into sterling for a UK-based investor, they haven't been nearly as rosy. But as I said, for what it's worth, 2 months, it's been a pretty good rally on equity markets. So what's sitting behind that? We've had a lot of questions, as you might well imagine, around inflation, and we've spoken about inflation at length throughout this year. Let's just remind ourselves of the narrative around inflation. Principally this came from supply side dislocations around COVID. You couldn't ship things. There was a lot of people sitting at home ordering goods because they couldn't go out and spend their money on services, and therefore you had this sort of double whammy of a lot of demand for stuff and a lot of difficulty actually delivering things because of lockdowns around the world. That was very much a 2020 story and into 21, and there was a lot of debate at the time about whether this inflation would be transitory, i.e. whether this was something that was just encapsulated in COVID and in lockdowns, and whether it would go away. We always said at the time that the crucial element there was whether inflation becomes endemic in people's mind, in the psychology of economies, and that's definitely what we're seeing now. You can't really open a newspaper or turn on the news without hearing something about inflation, and that's starting to tick over into the labour market, and we'll touch on that a little more in a second. So, UK CPI 11.1 for October, up from 10.1 in September, and you're starting to see the elements of where inflation is driven from being more widespread. So a lot of household goods, hotel stays, food prices certainly continuing to go up. And then, of course, in October, you had the way in which the UK retail energy market is organised, such that you had, despite the energy price guarantee, still another hike in household energy costs. So we know that structurally, from base effects, inflation is going to go down in the new year, but that doesn't really answer the critical question, which is how far it's going to go down, and will it ever get anywhere near to the bank's 2% target. So I mentioned that the sort of psychological effect and the importance of the labour market. If we go to the next slide, we can see that in play. So UK wage growth, having spent many years, in the doldrums, as it were, so not really, UK labour not really seeing wage rises much ahead, if any, of inflation. You're now still not in that position. You've still got inflation at 11 and wage growth at about 5, but you can see the pressures in the UK labour force, and you're starting to see wage growth. And one of the questions that we've been thinking about over the last few months is there bargaining power? Is there wage bargaining power within the UK labour force? And you've seen rail workers, you've seen postal workers, and now you're seeing nurses finding that there is shortage of labour supply, and the ability, certainly in those unionised sectors, to be able to start to negotiate up much better wage rises than they've experienced in the past. And markets are still very tight. So on the right-hand side, UK unemployment, you can see that's still very low. Slight uptick recently, and we're starting to see some of the pressures easing in the jobs market. But nonetheless, there are a lot of people who were in the workforce. We don't show it on this screen, but the participation rate is still falling. There appears to be, rather from an unexplained aspect of the labour market, people leaving the workforce. So although they're not employed, they're not counted in the unemployment figures because they're not registered as actually looking for work. So still very tight labour markets, and partly because the participation rate continuing to fall. Just against that, on the next slide, we can see that actually UK net migration, you've got that big fall associated with COVID, and people not being able to come to the UK, and indeed a lot of people leaving the UK. That has now significantly reversed. So we're seeing net migration much higher. A lot of change in terms of where people are coming from. So obviously with Brexit, less so from the EU, and a lot more from further afield. But suffice to say, you've got this issue where labour markets are still cheap, still tight, people leaving the workforce, but migration now coming in, and an expectation that migrant workers are going to fill some of that gap. Question really around whether it's the number of people in the workforce which is the issue, or indeed it's a skills problem. And certainly, speaking anecdotally to a lot of our corporate clients, there is still a big war for talent, a lot of demand for people, and not necessarily people with the right skills right now. And hence that's another driving force for wages. And you start to wonder whether you're going to get into the position where wage inflation starts to drive price inflation, and you get into that vicious circle. And that's really what central banks are worried about. They've never really given any indication since they started raising interest rates that they were worried about the supply side of inflation. And they've largely been ignoring that, acknowledging that will probably sort itself out. And we're starting to see that now, despite lockdowns continuing in China. But they were really more worried about what I mentioned earlier about, does inflation start to become a thing in the psychology of the economy? So that's the inflationary picture. And what have central banks been doing about it? Well, it won't have escaped your notice, and we've spoken about it on these webinars many times, that there has been an complete reversal of monetary policy in the UK, in Europe, and in the US. So the left-hand side chart shows us what markets' expectations of US interest rates are going to be for June of next year. And you can see, if you go to the left-hand side of that chart, back in June, July of last year, markets weren't really taking the Fed seriously. They thought there was going to be a slowdown coming much more quickly from an economic perspective, and therefore the Fed wouldn't continue with these quite aggressive rate hikes for much longer. And an expectation in the summer of this year, let's not forget that's only sort of 5 or 6 months ago, an expectation that rates would be around 3.2% in June of next year. What we've seen then is the Fed being extremely consistent. One or two voting members of the Fed have given some indication that rate rises might slow, but by and large, consistency and a unanimous voice from the Fed that they're going to continue to raise rates. And indeed, Jay Powell said, he's the chairman of the US Federal Reserve, said, we don't know yet where the terminal rate for interest rates is going to be. So from a 3.2 expectation for June next year, we're now looking at something in the region of 5% for next year. So interest rates are continuing. We do expect them to slow, interest rate rises to slow, and we do expect a pivot at some point next year, and George will talk a little bit more about that. But suffice to say, for the time being, no pivot, no change in policy, and continued tightening for monetary conditions. So certainly in interest rates, and then also with respect to the amount of money being put into the financial system, or more to the point, the amount of money being taken out of the financial system. We've said for many years that equity prices and bond prices have been supported by quantitative easing. Huge amounts of money put into the financial system off the back of the global financial crisis, that money not really making its way into the real economy, getting stuck into the financial system and inflating and elevating asset prices pretty much across the board. That's now being reversed since June of last year, and you can see here the amounts that the US is taking out of the system. So the numbers are quite big. We've seen over $100 billion taken out of the system in November alone. That's the dark blue line on the right-hand side of that right-hand chart, compared to the target, which is the light blue line, which seems like a huge amount of money, $100 billion, but actually, and George will talk about this a little bit later on, compared to how much has actually gone into the system over the last few years, nearly 5 trillion in the US just around COVID alone. This is really just making a small dent in that additional liquidity. But that having been said, you can see the pattern. They are accelerating, and they are going over target to compensate for previous months when they've been under target. So generally speaking, we've had an environment where lots of liquidity has been supportive for risk assets and possibly supportive for some enterprises that were of questionable value, and that now being withdrawn from the market. So for the short term at least, monetary conditions still remaining pretty tight. And what does that mean for bond markets? Well, when you look at credit spreads, markets are looking pretty stressed, and we think this is something that could be a factor in terms of when the Fed might decide to change course. What do we mean by credit spreads? Well, this is simply the extra compensation that a lender needs to lend to a corporate rather than lending to a government who is never going to default on that debt. So it's the fear that corporate borrowers won't be able to repay their borrowing, and therefore the extra compensation that investors demand for that. And you can see on the left-hand side, this is developed markets in the US and the EU, that extra compensation starting to get really quite high in terms of its historical average. So the EU is obviously nowhere near as high as it was during the Eurozone crisis in 2011. But if you look at the US and you ignore that big spike associated with COVID, the amount of extra compensation that investors need for taking on that risk is really quite elevated. And that's understandable because we expect we will go into recession. Most people expect we will go into recession, and that obviously has implications for corporate earnings and therefore the ability of companies to repay and indeed refinance their debt. So credit markets suffering, a little stressed. On the right hand side, what you're looking at there is the same chart, but for what you might call junk bonds or high yield bonds, if you're being a little bit more generous. So tend to be smaller companies, less credit worthy, and again, you want that bit of extra compensation for taking that extra risk. The dark blue line there is Chinese high yield, the light blue line is Asian high yield, and you can see that those markets are really quite stressed and really quite dislocated. China's got a whole host of issues that aren't necessarily affecting other developed markets, not least issues in its property sector. A lot of the debt in China is associated with construction firms, and that sector is significantly stressed because of the huge boom that they've had in their building and construction over the last decade, and that now looks to have been a little bit overdone and quite overheated. So a lot of stress in China, stress in Asia, because a lot of their debt is linked to the US dollar. And as I said earlier, we've had a very strong US dollar, although that's started to come off recently, which is putting pressure on Asian high yield markets. So those two lines sort of dominate the chart, but we shouldn't ignore the fact that European and US high yield market spreads are also moving up, and again, if you ignore the COVID spike, they're moving up to reasonably uncomfortable levels. So you're getting paid around, say, 12 to 15% on US high yield. So questionable about whether that actually looks good value in the long term, even if you factor in some corporate defaults. So bonds struggling. We've looked at the short-term picture in terms of asset prices. Let's just remind ourselves, if we can bear it, of what's happened year to date. And as you can see on the left-hand side, this is for what you might call a traditional balanced portfolio: 60% equities, 40% bonds. One of the worst years that we've had in quite some time, and very nearly approaching a worse year than 2008, when obviously we were in the midst of the global financial crisis. These numbers based on US equities and global bonds, and they're expressed in dollars. So it's not nearly as bad as that for a UK investor, because the pound has been, despite its recent rally, it's been pretty weak throughout most of the year. But nonetheless, we're still not through 2022, and there is still scope for it to be even worse than 2008, although I personally don't expect that to be the case. Why so bad for a balanced investor? Well, the right-hand side is showing you that in more recent times, although we've had quite a bit of equity market volatility over the last 15, 20 years, it's been just that. It's been equity market volatility, and whilst we've had interest rates coming down and staying down for a long time, the bond market's been pretty much unaffected up until now. Interest rates now going up, that devalues all of those bonds that you already have in existence. So for a traditional portfolio that does have that mix of equities and bonds, whereas previously you've had a bit of a cushion from your bond market holdings, now you're having a real double whammy, and you can see there the light blue line within the red box on the right hand side, global bonds actually doing worse than US equities in dollar terms at least. So the title of the slide is Annus Horribilis, and it should be fairly obvious why that is the case. Worth remembering, as I think I remind people most times we talk about this, we had pretty good years in 2020 and 2021, above average years for these portfolios, and certainly above average years for equities. A lot of that associated with what I mentioned before, free money going into the financial system and trying to find a home. So we shouldn't forget that some of this downturn is just giving back some of the sort of free gains that we had last year. So pretty rotten all round so far this year. Could have been worse. You could have been invested in Bitcoin. Bitcoin trading about 2 years ago at around $18,000, got as high as $64,000 just about a year ago, early part of November 2021, and it's now trading down at 17,000. We've sort of juxtaposed this against the interest rate environment in the US and ask the question, is this to do with liquidity? Are people exiting Bitcoin because, and other cryptocurrencies, because of that withdrawal of liquidity from the market? There is an obvious correlation there, but I don't think there's actually causation in this market. I think it's just symptomatic of the fact that a lot of people in the US received free money during COVID, and a lot of that did go into Bitcoin. You saw this very demand-driven rise in the Bitcoin price during that period. And then obviously, more recently, if you've been looking at what's been happening in that market, a lot of big failures associated with corporate entities and exchanges that aren't necessarily run in the most in a good way from a governance perspective. So just a little heads up there, we've never had Bitcoin in the portfolios. We've never intended to. We did put an article out about 2 years ago explaining why we wouldn't, and what we're seeing recently is just, I think, justification for why these new asset classes, and I use that term loosely, really can't be considered through the same lens as traditional things such as equities or bonds. So little segue into cryptocurrencies. Let's get back on topic. Where are we in terms of the economic cycle? And it's worth bearing in mind that we've had post-financial crisis sort of absence of the traditional economic cycle, where you had growth and then you had recession, and you had interest rate rises and falls associated with that in the normal sort of monetary policy cycle. We haven't seen that for quite some time. That's simply because central banks have been behind the curve, putting money into the financial system, and then punctuated by the COVID crisis, and that necessitating a further influx of money into the system. But inflation is back, monetary policy in its traditional sense is back, and we're now starting to see this traditional economic cycle and how central banks react to it very much in play. So inflation for the last couple of years, start of this year, central banks start to tighten. You then get the financial recession, i.e. that sell-off in equities and bonds, and eventually, the market moves ahead of the economy, but eventually you get that economic recession, which is what we're expecting to see coming up in the data reasonably soon. So that's where we are. We think we're on the cusp of an economic recession. Worth repeating that point that markets move ahead of economies. So just because we're going into an economic recession doesn't necessarily mean that it's going to be a tougher period for stock markets. They may well be looking 2 or 3 years down the line. So what everybody's looking for is this point at which recession becomes, recession becomes bad enough and inflation is tamed a little, where central banks have to about turn, as the vernacular is currently, central banks pivoting. And George will talk a little bit more about this, so I won't go on too long on it, but suffice to say, the Fed talks about a recession and a slowing economic environment being the catalyst for that change in monetary policy. We've already talked about the stresses you're seeing in bond markets, and we think that those bond market dislocations might actually accelerate the point at which you see the turn, or at least talk about a turn, from central banks going from putting interest rates up to starting to bring them down. So that is all I was going to say about what has happened in the recent past, and I'll hand over to George to pick up where we might go from here.
Thank you, David. One thing we need to realize is that we came off of an era called the Great Moderation, and it's lasted for a couple of generations. So, most of us do not remember a time when macroeconomic variables, the numbers, unemployment, GDP, were flying around and making it very difficult for businesses to plan, making it very difficult for investors to understand the environment. But that era is over. The pandemic killed it, inflation killed it, and a transition from an abrupt transition from an ultra accommodative monetary regime to a much tighter one have all resulted in a lot of volatility, macroeconomic volatility. So in this chart, I know it's a little bit convoluted. You see basically the standard deviation, how fast GDP is moving up and down in the UK and the US. The US is the dark blue line and the UK is the light blue line. And why are we showing that? To show that things are as volatile as they have been since the 70s. Okay, which means this is an environment that no person working today has really experienced before, a macroeconomic environment like that. Next slide. Now, it starts with the Fed. It starts with the US Federal Reserve. Why? Because the dollar is the world's reserve currency. It is the world's de facto global currency, which makes the Fed the world's de facto global bank, central bank. Now, when the Fed tightens, and it tightens very, very aggressively, other central banks are forced to follow. If they do not, say if the BOE refuses to follow the tightening, then the dollar will rise and the GBP will fall a lot. Now, because we're buying commodities, oil, iron ore, grain, whatever, in dollar terms, anything that we're net importers of, this means that we're going to pay a higher price just because of the currency. So if you allow your currency to depreciate very much, you're in essence importing US inflation. Nobody really wants that. So we're forced to tighten along with the US, especially the UK economy, which is very close to the US one. And that reduces economic activity across the board. Currently, many are projecting a recession, global recession in early or mid 2023. And of course, because things have happened so in such an abrupt way and such a disruptive way, we're also seeing a lot of financial volatility across the board. We'll talk a little bit more about that. Now, next slide. I won't dwell on it too long. This is how fast the Fed is tightening. The thick blue line, I tried to make it as stand out as I possibly could, because it is another convoluted graph, I'm afraid, is how fast we've tightened within the space of, say, 200 days. Only in early 1980 have we seen one cycle that was faster than this one. We saw similar tightening between 2004 to 2006, but this lasted for 2 years. It did not end well. It ended with a global financial crisis. And then another nearly crazy cycle in the mid 70s, But anything that relates to the 70s and the 80s also includes a change in monetary system. So we dropped the gold standard. We went to little little pieces of paper instead, um, and that caused a lot of inflation and a lot of volatility in interest rates. So what the Fed is doing, it has a strategy. We're going to front load rate hikes. We're going to do as many of them as we can as early as possible to beat inflation immediately. It's a questionable tactic because a lot of that inflation is imported by, through energy prices. Um, so you can't really regulate energy prices by hiking mortgage rates for American consumers, but it is the world's foremost consumer economy. So if they slow demand enough down, they're going to slow it enough for the world, and then the effect on inflation could be pervasive around the world. That's a strategy. That's what they're trying to do. Um, in their rush to do that, um, what they're doing, they're stressing the bond market. The bond market, after the global financial crisis, had a very easy ride. Every time anything went south, the Fed would print money. A, they're not doing that. B, they're hiking rates aggressively, and that is stressing bond traders, most of which are very young people because the older cohort disappeared because of central banks. By buying a lot of bonds, central banks have squeezed out a lot of a lot of trading desks. The new financial rules are causing banks to close their own proprietary trading desks. So a lot of these traders are young. And there are not nearly enough of them in the market because bond markets, they don't operate like a stock exchange, like, normal stock exchange, like you would know. Things don't just change hands just by writing some instructions. You call somebody or you message somebody and say, okay, you have a bond. A George Lagarias or a Mazar Sink bond maturing in 2025. I want it. How much do you want for it? Okay, it's an over-the-counter market, so it's not a very liquid market to begin with. Okay, and that market is now really, really stressed by what the Federal Reserve is doing. David showed some graphs, so we have liquidity issues in the bond market. Now, in this environment, next slide, please. In this environment, what we're seeing is the global economy slowing down. We saw obviously a massive contraction during the pandemic, a very nice rebound in 21, and now a slower crawl, but it's still contraction. Surveys suggest that most of the developed world will be contracting by next year in economic terms. Next slide. You can also see that in housing indices in the US. And the reason I'm not showing the UK is actually very purposeful, because UK hasn't responded so abruptly. It's the US that started this trend, and you can see the volatility, but the sheer volatility, but also how fast housing conditions are deteriorating. On the left-hand slide, you have a survey from the National Association of Home Builders. How good are you feeling going forward? And as you can see, things are as bad as they were in 2005, subprime crisis, for those of you that remember it. On the right-hand side, it's pretty much the same numbers in a different way. Existing and new home sales and building permits all dropping significantly, especially existing home sales, because the larger part of the housing stock is the existing houses, it's not the new houses. Okay, so if they're dropping, that has a significant effect on the housing market. And it's not just that, it's supply chain problems on the horizon. On the left-hand side, we have the Mazar supply chain index. If it goes up, things are tighter. If it's at zero, things are where they're supposed to be, and it hasn't been at zero since 2020. And there are some indicators, especially around China, that are flashing red. You've read the articles about iPhone factories closing because of COVID. You've seen now probably the demonstrations in China where they're holding their white papers in protest. There were some images of tanks on the streets, very reminiscent of 1989. So there is still a problem with China, because China is at the heart of the global supply chain. Next slide, taking it all into perspective, economists are now seeing a sharp deterioration in 2023 growth, especially for the UK, which has well-known idiosyncrasies that we don't have much time to discuss. So 0.8 contraction for UK GDP, 0.1 for the EU. The consensus of economists still forecast the US growing by 0.5%, but that could quickly deteriorate into the negative territory as well if you see the trend is really downwards. So all in all, next slide. Is a very bad environment, economic and financial. And in a bad environment, risks are being are more pronounced. So we're seeing a lot of systemic risks out there: higher inflation, bad geopolitics as a result of all that. Central bank policy errors, because central banks really, they don't have an easy way out of this. It's inflation they can't really control, and they need to do something. So they're doing the best they can. It's a question of whether it's right or whether it's enough. The global recession, Chinese economy deteriorating, and the global bond market unraveling, and European cohesion, because European cohesion is now basically the euro as a currency is being held together by the ECB. If the ECB starts tightening very abruptly, then this could cause problems within the single currency market. And off the back of that, we could see corporate debts and defaults. Very purposely, I kept Brexit complications into the into the worry now but worry less column. Brexit complication right now is a tight jobs market. And as David said, the people are there, they're just not skilled. So it will take a year, it will take two, it will take pain, but these extra people will be reskilled. Okay. I'm much like many others. I work for a salary, and if I've learned anything in my 20 years career is that very few people are really irreplaceable, but it does take time and it does take training. Next slide. Let's talk a little bit now about the encouraging signs, because I know my part of the presentation is not easy. First of all prices are dropping. Chinese producer inflation is dropping. We're seeing factory prices off the gate dropping as well across various surveys. So I won't say global inflation has peaked, although I'm tempted to, but we're seeing some encouraging signs going forward. And that's where I will leave this. Next slide. In the UK, interest rates are already at 3%. They could go as high as 4.5%. I listened to Hugh Peel, the Bank of England chief economist, this morning, who said that the 5%, 5.25%, was deemed to be too tight. So he reasserted the 4.5%, which is what current markets currently think. So we're 2/3 of the way there. Okay, and that's encouraging too. But the really big thing is the Fed pivoting. And when we say pivoting, I mean going from ultra tight to a little bit more accommodative. Now, when it was very accommodative, it was sending signals to markets: I'm accommodative, you guys should spend your liquidity on buying risk assets. Now it is sending the exact opposite signal by tightening. That's the chart that David showed. It's saying, I'm doing the tightening, but you should take your extra liquidity and keep it as well. This is the signal it's sending to market. So when we're saying pivoting, we're assuming some sort of a signal which should say, okay, maybe I'll keep conditions tight on my end, but you guys should feel free to spend your liquidity because I'm here in case things start to go wrong again. The so-called Fed put being reasserted. We printed over 5 trillion just after 2019. We've taken back 350 billion. So really a drop in the ocean. And global fund managers, they have record amounts of liquidity. Everybody's just waiting for the Fed to pivot. The private equity funds have nearly 2 trillion of dry powder. That's extra liquidity they haven't spent. So there is a lot of liquidity out there waiting for the Fed to pivot to signal. Next slide. This is expected to happen at some point in H1 2023. That's what the market expects. Why? Because what we will see is also a more balanced Fed. The FOMC, the Federal Open Markets Committee, is the committee that votes for interest rates, and it's going to feature a lot less hawks and a few more undecided or doves. Going forward in 2023. So that change in the team is generally viewed upon favorably by markets. Now, how the pivot will look, what will the pivot look like, and how will it take place? Next slide. It is we're looking at an orderly pivot and a disorderly pivot. An orderly pivot includes, this is very important, the acknowledgement of some sort of an external risk buildup. It's a signal to the market that we said that the Fed put is in effect. Don't worry, we have a safety net here, we'll catch you. In this scenario, rates peak at about 5% and they stay there. Inflation de-escalates gradually, especially after H2 next year. Quantitative tightening is going to persist, maybe not at the present rate, but it's going to persist, and the long-term yield curve is going to steepen. But there is a danger that if pressures in the bond market persist, something might break in the bond market. So if that happens, then the Fed might react quickly. We could see a fast escalation of rates, quantitative easing instead of tightening, a flat yield curve, and I'm not sure how inflation is going to develop because we're abandoning that target now and going on to saving the markets mode. So I would expect in that scenario inflation to persist for some time. But of course, the interest rates are really one element of inflation. There's the war and all of that. So my final slide, it starts with the Fed. That's when the liquidities, the economic cycle started to become more difficult. And it's going to end when the Fed is done with tightening. And yes, I know it's disheartening to feel like we don't have control over our fate and just some central bankers, but these are the realities of the global economy. The economic recovery will lag the financial recovery. So first, we're going to see a rebound in portfolios, and 6 months, 9 months after, the economy will begin to feel better because that's just how liquidity conditions work. It is all about liquidity. A looser Fed can unleash a lot of liquidity. When can we expect it? The more the bad news right now, the faster, the more forward we bring that Fed pivot. Okay, having said that, some point in H1 is what the markets are expecting. And finally, because David touched upon this, it wasn't a good year for diversification. Bonds and equities fell at the same time. We don't expect this to become a trend. In fact, higher yields are helping with long-term diversification. So long-term, the basic tenets of a portfolio, of an investment portfolio, not only hold from where we are today, but they might actually improve. And with that, I can leave it open to questions.
Thank you very much indeed, George. We've a little time for questions, so let's get through as many as we can. There's been I said I'd concentrate on the ones that have been pre-submitted, but there have been a couple of good questions come through while we've been talking. One around the value of Bitcoin. How is that value derived? The simple answer is it is simply a function of speculation on its future price and driven by demand and supply. There is no intrinsic value to Bitcoin. Yes, it's used as a currency to some extent, but used possibly in areas where people are trying to hide those transactions rather than in more regular and authentic transactions. I know Tesla did at some point say that they would accept Bitcoin in exchange for a car. I'm not sure that anyone actually ever did that. So we think the value of Bitcoin is whatever it is that whoever's trading it decides it is on one particular day. There's no anchor to it. It's simply derived from demand and supply, and that I think makes it extremely speculative as an asset class, if indeed you want to call it that. George, obviously a lot of questions about inflation. Let's just pick up a couple and try and combine them. Are current inflationary effects systemic? And if not, when can we expect to see the base effects drop out and the eventual drop in interest rates?
The base effect should begin to appear in Q2 or Q3 next year. This is all other things being equal. If inflation remains steady in the UK, that's where we expect to see it. I assume we're talking about UK inflation. US inflation is maybe a quarter earlier than that, if we're looking for the Fed pivot. Sorry, David, what was the second part of the question?
With when we expect to see the eventual drop in interest rates, which I think you've already touched on, to be fair, George.
Yes. So I think in the orderly in the orderly pivot scenario, we would expect to see a drop in interest rates at some point late in next year. In the disorderly scenario, it could be a lot quicker than that.
Thank you. A couple of questions about the UK housing market, because we showed a graph on the US, and questions effectively saying, what are our predictions? Do we see a decline in UK house prices? I mean, it's difficult to make an argument that won't happen. You've obviously got the cost of borrowing gone up very significantly. So not only have you got those people trying to enter the housing market, but you've got those people who are coming off their 2-year or the 5-year fixed rate deals having to refinance at much higher levels. All that against a backdrop where you're having to pay more for your energy and your food, etc., and the potential for a recession where some people may unfortunately lose their jobs. So it's difficult to paint a rosy picture for the UK housing market, and we wouldn't be at all surprised to see prices coming off quite a bit. New mortgage approvals figures came out just this week, I think, and they were 10% lower than the previous month. That having been said, the UK housing market does have its idiosyncrasies. We do have a shortage of housing stock in this country, which in and of itself acts as a support in the housing market. Generally, what we've seen in recent times is not so much house prices falling in terms of transactions, but really just transactions drying up and activity in that area dying off. That in and of itself not particularly good for the UK economy. So that's house prices. George, going back to interest rates, this is what I think is a really good question from about a cautious investor. So those investors who've held bonds in their portfolios and have seen a nice steady rise, a nice steady journey over the years, and this year, as we talked about earlier on, seeing a significant drop off in value. So the question is, as interest rates rise and are forecast to rise further, should the cautious investor be considering transferring their investment elsewhere? I think the key word in that question is forecast, i.e. we already know that interest rates are going to go up.
My answer is, in this environment, a cautious investor, should they become more cautious or less cautious? Because ultimately there is a profile, a risk profile, and it works if you keep to the long-term strategy. Changing the risk profile, changing your profile to match the general conditions is probably ill-advised as a strategy. I've seen it many times. But to be fair, the cautious investor, first of all, they should keep to the profile, and second, they should start to look at bonds again, because bonds now have yields. And a diversified portfolio, because a cautious investor also is going to have a lot of bonds in their portfolio. A cautious investor now will see higher bond yields going forward. Bonds are not a destroyed asset class. In fact, they're twice as large as equities. And now they have a yield. They've normalized quite a bit. So going forward, you took the loss, the cautious investor. Now be patient to take the win.
I think that's absolutely right. And as you will know, George, we've increased within our portfolios our bond allocations over the last sort of 2 to 5 months, because albeit for a bond investor, that rise in interest rates is actually quite painful because it devalues what you're already holding. What you actually want in the long term as a bond investor is higher interest rates, because it stands to reason you're getting paid more for lending to whoever it is that you're lending to. So investors need to be aware of that psychology of trying to avoid coming out of things after they've gone down and going into them after they've gone up. And we certainly think that is very relevant to the bond market right now. Let's squeeze one final question in, George, a slight change of tack, but sort of relating to the end of a cheap money era and the fact that there's some recessionary forces at play. There's a question about M&A activity. So do we think there's going to be a change in the M&A environment? And the second part of that question is, do we think that a weaker pound is going to encourage overseas investors into the UK?
Okay, so M&A tends to do very well at the peak and the trough of the economic cycle. So we're now nearing, or we're getting to the trough, and the financial cycle. Why? Because valuations are low. So this is actually the time for good M&A, because in peak times you're buying whatever is in front of you at whatever valuation there is. But now it's a buyer's market, and buyers can be picky and they can pick off distressed assets, good assets in distressed prices. Now, there's always talk about how the lower pound might encourage investors. I'm Greek. I'll give you my personal experience. Yes, but there is a limit to that, because then the question is, what sort of investors are you attracting? If you're attracting, predatory hedge funds like Greek businesses do, just because they were devalued a lot, then that's not the type of investor you want going forward. So on the one hand, yes, you tend to attract more investors if you lower your currency. On the other hand, this cannot be the sole basis for investments, because you're not getting the right investors.
Thank you, George. I mean, I certainly agree with the point about there being more constructive and better M&A in a period of economic difficulty. I wonder whether the bank's appetite to lend on some of this stuff may well be diminished, but we shall see. Listen, we better leave it there. George, thank you very much indeed for joining me today. Thank you most of all to you at home or at work for coming and spending your time with us this morning. We certainly do appreciate it, and we hope to see you at the next edition of this webinar, which will probably be in the new year. Thank you very much.